In this lesson, ranging markets, the learning objectives are: you should know how to trade in ranging markets, and you should know the advantages and disadvantages of ranging markets. In ranging markets, prices are bouncing between certain levels and remain in that range for a certain time. These levels are support and resistance zones. Prices don't make new highs, but tend to repeat its highs and fall to previous lows, making peaks and valleys. A ranging market with low volatility can also be called a flat market. The most common conformation of a ranging market is when the price hits the same support and resistance levels 3 times. A common way to trade ranging markets is to sell when price touches resistance and buy when price touches support. Price can never hold at these levels forever. That means prices can break out of the support and they can break out of the resistance levels. And you can also sell or buy when price breaks out of these levels. Trading ranges has advantages. There are clearly stated levels for range-bound trading. When you have a range on the chart, you have a clearly stated high and low of a horizontal channel. This means you know when to expect a likely price bounce in the opposite direction. Another advantage is you can enter a potential trend quicker. When a valid breakout occurs out of a range, you can enter a position in the direction of the price move, trading the initial breakouts. It can offer a very desirable reward to risk ratio, and turns out to be quite profitable when the breakout extends into a sizable impulse leg. The main disadvantage for trading ranges is price uncertainty. Price is very uncertain during range channels. The reason for this is the low trading volumes, which can often lead to false breakouts and whipsawing price action. I would suggest you use multiple time frame analysis. Because to spot a pair trading in a range, it is good to look at other time frames. That is because price would seem to be in a tight range on a daily or weekly chart, but have a different trend on a smaller time frame chart. Therefore, looking at multiple time frames allows you to see a different angle on the market, and you can possibly see better opportunities by looking closer or further back. Just as there is some indicators that work best for trading markets, some indicators work best for ranging markets. One example of this is the average directional index. The average directional index is a technical indicator which helps us distinguish trends from flat price movements. The indicator consists of a single line which fluctuates from 0 to 75. If the line is located below 25, this indicates that it is in a range-bound market. We have a whole lesson for the average directional index indicator in the previous section. You should take a look if you don't remember this. We've also covered this indicator before, the Bollinger Bands. But I'll remind you if you have forgotten. The Bollinger Bands is a volatility-based indicator. Low volatility is usually caused by low trading volumes, and high volatility is usually pressured by higher trading volumes. Therefore, the Bollinger Band indicator is useful in identifying the range and trends. When the two Bollinger Bands are tight, then volatility is low and the market is quiet. And when the two bands start expanding, then volatility is high and the market is moving. When the Bollinger Bands are horizontal, this means that the market is range bound. Using this information, you can buy at support and sell at resistance. In this market, you should pay close attention to the middle line. If you buy at the support and then price manages to move above the middle line of the Bollinger Band, it is a sign that the bulls are in control and that the price will have a better chance to test the upper side of the band. Similarly, if you short at the resistance level and the price manages to move below the Bollinger Band middle line, it is a sign that the price will likely reach the support level. You should also use oscillators. Using oscillators like stochastic or RSI will help increase the odds of you finding a turning point in a range, as they can identify potentially oversold and overbought conditions. You should also trade breakouts. A common fact about the range-bound markets is that they don't last forever. The eventual outcome of ranges is that they break out. Therefore, the main risk of using the support and resistance levels when trading market ranges is that the price could break out. So, knowing this, you can enter the market if the price creates a breakout through the upper or the lower level. You would enter the market in the direction of the breakout. If the breakout is bearish, you sell the currency pair. If the breakout is bullish, you buy the currency pair. However, it is not advisable to short after a bearish breakout or buy immediately after a bullish breakout. That is because in most cases there are usually false breakouts. In most cases, the right strategy is to wait for the price to retest the support or resistance and then trade in the breakout direction.